Hi students, I am Prakash, Chartered Accountant and acting as academic advisor in Masterminds from the past 20 years. Here is a short video introducing matchless Masterminds briefly for the convenience of the students who came to this channel for the first time. Masterminds was established in the year 2002 and has been acting as a reliable platform to offer coaching for CA and CMA courses. Masterminds is undeniably the pioneer and the leader in MEC, CEC, CA and CMA courses with nearly 20,000 admissions per annum. This is an incredible initiative by three edupreneurs, namely Mohan, Radha and Prakash, that is me. All three qualified CA at a very young age of 21 years and started this organization under the mentorship of my father, Mr. M. Siv Prasad Garu. So Mr. Mohan is my brother and Radha is my sister-in-law. And by the way, it's me, Prakash, Chartered Accountant. So here are the courses for which we offer the coaching. We offer coaching for MEC, CEC groups exclusively at intermediate level, and we also offer integrated coaching for MEC along with CA, CMA Foundation. And we also take exclusive admissions for CA, CMA Foundation or CA, CMA Inter. And we also offer coaching for CA, CMA final level as well. Recently, we have started a unique academic program at intermediate level, that is MEC Pro, aiming for the students who want to pursue BBA or MBA or CLAT courses in future rather than CA or CMA, and we have received a huge applause for the same. So 20 years of experience, and we have finished more than 155 batches of CA or CMA Inter in Guntur alone and similar number of batches in all our branches together. So till now completed 17 batches of CMA Inter and 18th batch is going on. Successfully completed 25 batches of CA final till now and 26th batch is running now, and we have also successfully completed 4 CA or CMA final batches in Hyderabad. So till now our students are able to achieve 990 All India ranks at various levels of CA, CMA courses, and our students are able to achieve first rank for 48 times in various courses for which we offer coaching. So in a single year, our students are able to achieve 3 All India first ranks in the year 2020, and till now our students are able to achieve state first rank at MEC intermediate level for 18 times, that too 8 times in a row. In a single attempt, our students are able to grab 98 All India ranks at CMA Inter and final results of January 2021 and our All India ranks in February 2022 CA results. And here are the 10 All India ranks in CA final results of 2021 alone. And till now, our students are able to secure 93 All India ranks at IPCCR CA Inter level in the last 9 years. And here is our physical presence: Guntur, Vijayawada, Hyderabad, Amirpet, Dilshuk Nagar, Vizag, Tirupati, Kurnool and Rajahmundry. And here are the locations where we have branches. And here are the contact numbers. Here is the list of our physical presence and here is the list of our online presence. And for your kind information, we don't have branches in any other locations other than stated here. So please do install our Android app Masterminds Online Classes from Google Play Store, and if you belong to iOS platform, then install an app called Class Plus from Apple Store and enter the organization code as MZGUN. In this app, you can find a large number of useful content like regular batch videos, crash batch videos, rapid revision batches, guidance classes, motivational videos, amendment videos, Masterminds test series, whatnot. Large amount of useful content is already available in the app. In our app, you can find a section called study material where large amount of free content is also available, and till now more than 24,000 students have already downloaded our app and we are nearing to 25,000. Sir, is it possible to interact with the directors directly? Yes. If it is an administrative issue, you need to contact Mr. Mohan sir on this mail ID. If it is academic issue, you need to contact me on this mail ID. So thanks to all our students who are our true brand ambassadors and who helped us to reach this position. All the best.
Dear students, today I am going to discuss RTP May 2022. So, first problem, sir, related to material chapter. Sky and Company, an unregistered supplier under GST, purchase material from Y Limited, which is registered under GST. The following information is available for one lot of 5,000 units of material purchase. So, here question is asking you are required to calculate cost per unit of material purchased by Sky and Company. So, that means question is asking calculate unit price of raw material. So, at the time of raw material purchase, some additional costs are incurred. So, these costs are added to raw material purchase cost. Then we get total cost divided by net usage quantity. We get unit price of raw material. Okay, right. List price of one lot 5,000 units, price 2,50,000, sir. Trade discount 10% on list price. List price means MRP price. So, MRP value of 5,000 units 2,50,000, sir. Trade discount to 10%. So, 10% of 2,50,000, 25,000. That should be deducted from invoice value. Okay. Trade discount means discount offered at the time of raw material buying, that is calling as trade discount. So, here trade discount is 10% on list price, that should be deducted from invoice value of material. So, this one trade discount at the rate of 10% invoice value. Net invoice value 2,25,000. Next, taxes and duties. Here CGST, central GST and state GST, credit not available, sir. So, input tax ITC not available. So, this item charge it to the customer. So, 13,500, 13,500. So, finally 2,52,000. Next, cash discount, sir. So, will be given only if the payment is made within 30 days. So, this is pure financial item. While preparing the cost statement, pure financial items are not taken into consideration, simply ignored. Next, toll tax paid, that is added to raw material cost, freight and insurance added to raw material cost. So, see this toll tax, freight and insurance. Commission brokerage paid, that is also charged to the customer. So, next amount deposited for returnable containers 30,000, amount refund on returnable containers 20,000. So, finally take the difference, 10,000 cost incurred for containers. So, that should be added to raw material purchase cost, sir. So, 10,000. Next, other expenses 2% of total cost. Sir, here except other expenses, remaining cost equal to 2,94,000. This amount equivalent to 98%, sir. So, 2,94,000 divided by 98 into 2%, 6,000. So, that is the other expenses amount. So, total cost of material 3 lakhs. Shortage material due to normal reasons 20%, sir. So, net quantity 4,000, sir. 3 lakhs amount to 3 lakhs amount divided by 4,075 rupees. Here note point, GST is payable on net invoice price. Okay, cash discount is treated as interest and finance charges, that is a pure financial item, hence it is ignored. Demurrage is penalty imposed by transporter for delay in uploading or offloading of materials. It is an abnormal cost and not included. Sir, fines and penalties and abnormal items are appearing only in financial books, not in cost books, sir. Shortage due to normal reasons should not be deducted from cost to ascertain total cost of goods units. So, simply quantity less, sir, total amount passed on to customer. So, finally Good units 4,000 units, sir. 3 lakhs amount pass on to good units. So finally, unit price of raw material equal to 75 rupees. So this is the material chapter. Next, employee cost, sir. A total of 108 labor hours have been put in a particular job card for repairing work engaging a semi-skilled and skilled labor. So semi-skilled labor name Mr. Deep, skilled labor Mr. Shyam respectively. The hours devoted by both the workers individually on daily basis for this particular job are given below. Monday 10.5 hours, Tuesday 8 hours, Wednesday 10.5 hours, Thursday 9.5 hours, Friday 10.5 hours. Skilled labor also worked on Saturday. Okay, so for 10 hours. Next, Sunday is weekly holiday and each worker has to work for 8 hours on all weekdays and 5 hours on Saturdays. The workers are however paid full wages for Saturday, 8 hours for 5 hours worked. Sir, on Saturdays 5 hours working, sir, but payment given for 8 hours, sir. Working hours 5 hours, but payment given to 8 hours on Saturdays. Semi-skilled and skilled workers is paid ordinary wages 400 rupees and 600 rupees respectively. So semi-skilled workers ordinary wage amount 400 rupees, skilled workers ordinary wage 600 rupees per day of 8 hours. So suppose hourly rate in case of semi-skilled workers 400 divided by 8 is equal to 50 rupees. In case of skilled workers 600 divided by 8 equal to 75. So extra hours worked over and above 8 hours are also paid at ordinary wage rate. Extra hours worked over and above 8 hours are also paid at ordinary wage rate. Our overtime premium of 100% of ordinary wage rate if a worker works for more than 9 hours. So suppose for example in Monday working hours 10.5 hours, sir. Normal working hours 8 hours. 1 hour is extra hour above 9 hours, that is the overtime hours, 1.5 hours overtime hours, sir. Okay, next you are required to compute the wages payable to Mr. Deep, semi-skilled worker, and Mr. Sham, skilled worker. See the suggested answer. Calculation of total normal hours to be paid for Mr. Deep. So semi-skilled worker, sir, on Monday total working hours Monday total working hours 10.5 hours. Out of 10.5, 8 hours normal hours, 1 hour extra hour. So 8 plus 1, 9. So 10.5 minus 9 equal to 1.5. That is the overtime hours. So in overtime hours, however, overtime premium 100% of ordinary wage rate. So that means double amount. So 1.5 hours is nothing but equal to 3 hours payment, sir. So finally 8 plus 1 plus 3, 12. Next Tuesday working hours 8 hours, sir. So 8 extra hours nillu, overtime hours nillu. Finally payment hours 8 hours, sir. Wednesday 10.5. So 8 hours normal hours, 1 hour extra hour. Above 9, 1.5, sir. This is equivalent to 3 hours, sir. Total payment hours, total paid hours 8 plus 1 plus 3, 12 hours, sir. In Thursday 9.5 out of 9.5, 8 normal hours, 1 extra hour. So 9 plus overtime hours 0.5 hours. So equal to 1 hour payment, 8 plus 1 plus 1, 10 hours. Friday 10.5, sir. So 8 hours normal hours, extra hour 1 hour, overtime hours 1.5, so 12 hours. Okay. So in case of semi-skilled, Saturday working hours nil, sir. So finally paid hours equal to 54 hours. In case of Mr. Sham, that is skilled worker, so calculate the paid hours, sir. So Monday same 12, Tuesday 8 hours, Wednesday 12, Thursday 10, Friday 12. But Saturday 5 hours, sir. Saturday 5 hours. Saturday, skilled labor also worked on Saturday 10 hours, sir. So 10 hours. Out of 10 hours, 5 hours is the normal hours. Am I right? Next, 3 plus 1, 4. So above 9, that is considered as overtime, sir. Sir, overtime means above 9 hours is considered as overtime. So here, out of 10 above 9, only 1 hour, sir. That is equivalent to 2. So here extra hours, 4 hours. So 5 plus 4 plus 2. Total paid hours 11 hours. So finally 65 hours. Okay, right. Next, wages payable. Basic wage rate per hour equal to 400 by 8, 50 rupees. Mr. Sham 600 by 8, 75 rupees. Dearness allowance per hour at the rate of 20%. 20% basic wage rate, sir. So 20% of 50 rupees, 10 rupees, 20% of 75, 15 rupees. Hourly rate equal to, so finally 60 including DA. In case of Mr. Sham 90. Total equivalent to normal hours, that is the paid hours. 54 to 65. Finally wages payable 3,240, 5,850. So this is the employee cost, sir. Next one. Overheads. Absorption costing method. Right. So Pitch Limited is a manufacturing company having 2 production departments, namely A and B, and 2 service departments X and Y. The following is the budget for March 2022. So here 2 production departments and 2 service departments. Direct material cost of production department A, it is a part of prime cost. Direct material cost of production department B, it is a part of prime cost. Direct material cost of service department X, that is overhead. So direct material cost of department Y, 2 lakhs, that is overheads, sir. So whatever amount spent in service department, that should be considered as overhead, sir. So okay. So direct wage cost of service departments overhead, sir. Direct wage cost of production departments, it is a part of prime cost. Next, common overhead items. Common overhead items. Common overhead items are apportioned. Common overhead items are apportioned on a suitable base and then charged to respective centers, respective cost centers. Here factory rent, sir. So 9 lakhs. That amount apportioned on the basis of area. Next, power, kilowatt hours. Sir, here kilowatt hours not available, sir. How to calculate kilowatt hours, sir? Working hours, machine working hours into horsepower of the machine multiplied, then we get kilowatt hours. Next, depreciation. Depreciation, capital value of asset. General lighting, that means light points. Next, perquisites. Perquisites means direct wage cost. Direct wage cost. See the table, sir. So primary distribution summary. Direct materials directly given. So direct material cost of production department A, it is a part of prime cost. Direct material cost of production department B, it is a part of prime cost. Direct material cost of service department X is a overhead. Direct material cost of service department Y, it is a overhead. Whatever amount spent in service department, that should be considered as overheads. So same thing in direct wage cost, sir. Next, factory rent, basis area, power. So here power horsepower into Mr. Hours is nothing but kilowatt hour, sir. Horsepower into Mr. Hours is nothing but kilowatt hour. See the working out. So finally 10 is to 16 is to 3 is to 5. Next, depreciation, capital value of asset, general lighting, light points, perquisites, direct wages. Okay. So this is the primary distribution summary. Next, prepare a statement showing the redistribution of service department expenses to production departments. That is calling as secondary distribution, sir. So secondary distribution can be done under 3 methods, sir. Simultaneous equation method, trial and error method, repeated distribution method. Here questioner is asking 3 methods, sir. Simultaneous equation method, trial and error method, repeated distribution method. So see this table, sir. Here X department providing services to A, B and also Y. Y department providing services to A, B and also X. So there is a cross service between the X and Y, sir. So this is the reciprocal method. Under reciprocal method, first we have to calculate total overhead amounts of each service department and then start the reapportionment of service department totals to production department, sir. So first of all, we have to calculate total overheads of each service department, total overhead costs of each service department by using simultaneous equation method or by using trial and error method. In case of repeated distribution method, so no need to calculate total overheads, sir. Directly distribute the overheads to production department, sir. So that is the benefit of repeated distribution method. Here question is asking three methods, sir. So first simultaneous equation method. See these equations, simultaneous equations. So solving the two equations, finally we get y value 13,37,374, x value 9,86,869. So finally we get totals of each production department. After making the second distribution summary, we get estimated overhead cost of each production department. So EOH of production department A 21,05,202, EOH of production department B 14,04,798. Okay, so this is the simultaneous equation method. Next, trial and error method, sir. So trial and error method, as per primary distribution summary, cost of providing service of X department 9,20,000, cost of providing service of Y department 11,40,000. Then start the distribution, apportionment of department X to department Y, that is 20% 9,20,000, sir. See this table, 20%, yes. Next, apportionment of department Y expenses to department X. So 5% of 13,24,000, that is 66,200. Next, apportionment of department X to department Y 20%. So here X providing services to Y 20%, Y providing services to X 5%. So that up to single digit number, continue the distribution, sir. Finally, we get estimated overhead cost of X service department, estimated overhead cost of Y service department. After making this, so totals 9,86,869, 13,37,372. Now distribute the second distribution, sir. Service department totals are reapportioned to production departments after making the second distribution. So EOH cost of A, EOH cost of B. Sir, in previous simultaneous equation method 21,05,202. In this method also 21,05,201. So just 1 rupee variate, sir, due to decimals. So answers will be same, sir. Next, redistribution of service department expenses to production departments using repeated distribution method. So in this method, no need to calculate totals of each service department. Directly distribute the cost of providing service up to 0. Directly distribute the cost of providing service up to 0. So finally we get 21,05,201, 14,04,799. One thing is observed, sir, in 3 cases EOH of each production department same, sir. So answers will be same. So this is the overhead chapter, sir. Next, activity based costing. PCP Limited belongs to the apparel industry. It specializes in the distribution of fashionable garments. It buys from the industry and resells the same to the following two different supermarkets. Supermarket A dealings in adults garments. So that is the age group is just 15 to 30. So that is the indication, age indication. So adults garments age indication 15 to 30. Supermarket B dealings kids garments, age group 5 to 10. The following data for the month of April in respect of PCP Limited has been reported. So April month Revenue details are given. Average revenue per delivery in supermarket A 1,69,950. Average revenue per delivery in case of supermarket B 57,750. Average COGS per delivery in case of supermarket A 1,65,000. In case of supermarket B 55,000. Number of deliveries made in the month of April 660 sir in supermarket A. Number of deliveries made in the month of April in supermarket B 1,650 sir. So in the past PCP Limited has used gross margin percentage to evaluate the relative profitability of its supermarket garments. So previously company follows gross margin percentage to evaluate the relative profitability of its supermarkets. Now the company plans to use the activity based costing for analyzing the profitability of its supermarkets. So therefore activity based information available sir. So the April month operating cost other than COGS are 16,55,995. These operating costs are assigned to 5 activity areas. The costs in each area and activity analysis including cost driver for the month of April are as follows. Activity area, store delivery, activity area cost 3,90,500. Driver name store deliveries, cartons dispatched to stores, that is the cardboard boxes. Here cost incurred 4,15,250 for this activity. So here cost driver name is cartons dispatched to a store per delivery sir. Next shelf stocking, so that is the storage at customer store. Here cost incurred for this activity 64,845. So here cost driver name is hours for shelf stocking. Next line item ordering. Here cost incurred for this activity 3,45,400. Here cost driver name is line items per purchase order. Customer purchase order processing 4,40,000. Here driver name is equal purchase orders by the customers. Sir, other data for the month of April include the following. Total number of store deliveries. In supermarket A 1,100. In supermarket B 2,805. Average number of cartons shipped per store delivery 250. Average number of hours shelf stocking per store delivery 1.5. So average number of hours shelf stocking, that is the storage time per store delivery 6 hours. In supermarket B 1.5 hours. Average number of line items per order 1412. Total number of orders 770, 1980 required. What they are asking in this question sir? First bit, compute gross margin percentage for each of its supermarket segments and compute PCP Limited operating income. Sir, gross margin percentage, how to calculate sir? Revenue minus COGS, we get gross margin. Gross margin divided by revenue into 100, gross margin percentage. And compute the company operating income. How to calculate the company operating income? Company revenue minus company COGS. Then we get company gross margin. So company gross margin minus company operating expenses, we get the company operating income. So operating income divided by revenue equal to company operating margin. Okay, let's see the side answer. See this PCP Limited sir, company name PCP Limited, statement of operating income and gross margin percentage for each of its supermarket segments. Here particulars, revenue of supermarket. So 11 crores 21 lakhs 67,000. In case of supermarket B 9 crores 52 lakhs 87,500. So company revenue 20 crores 74 lakhs 54,500 sir. Less COGS, then we get gross margin. So in case of supermarket A 32 lakhs 67,000. In case of supermarket B 45 lakhs 37,500. In case of company 78 lakhs 4,500. Less other operating cost. So 16 lakhs 55,995. So finally operating income sir. So 61 lakhs 48,505. This is the operating income of the company. Okay, next gross margin 2.91, 4.76, 3.76. So how to calculate the gross margin percentage sir? Gross margin divided by revenue into 100. How to calculate the operating income percentage sir? Operating income divided by revenue into 100. Next, operating income statement of each distribution channel in the month of April using activity based cost information. Okay, right. Sir, first before going to this one, first we have to calculate cost driver rates. Here working notes. So computation of rate per unit of the cost allocation base for each of the activity areas for the month of April. So store deliveries, sir. So here first activity, store delivery activity. So in this activity, cost incurred for this activity 3,90,500, sir, divided by total store deliveries. Total store deliveries 770 plus 1980, sir. Store deliveries 1100 plus 2805, sir. Here total number of store deliveries, so 1100 plus 2805. 1100 plus 2805. So therefore cost driver rate per store delivery equal to 100 rupees. Cartons dispatched. Here average number of cartons shipped per store delivery 250. Per store delivery 250. So total total cartons 1100 into 250. 1100 into 250. Okay. Next to 2805 into 50. 2805 into 50. Okay. So finally, so cost driver rate equal to 1 rupee per carton dispatch. Next, average number of hours of shelf stocking per store delivery 6 hours. So 1100 into 6, sir. 1100 into 6. Next, 2805 into 105. So finally cost driver rate equal to per hour 6 rupees, sir. Next, line item ordering 10 rupees per line item order. Customer purchase order processing 160 per order. Here average number of items per order 14 12. So average number of line items. Okay. Next, total number of orders 770 1980. 770 1980. So customer purchasing order processing. So customer purchase order processing total orders 770 plus 1980. So cost incurred for this activity 4,40,000. So divided by total orders. So finally cost driver rate equal to 160 rupees per order. Now computation of operating cost of each distribution channel. So using these rates, apportionment of the operating cost. Now supermarket A operating activities cost of 6,55,600. Supermarket B operating activities cost of 10,395. So finally we get operating expenses of each supermarket, of each channel. Now calculate the operating income statement of each distribution channel in the month of April. So supermarket A, supermarket B. Sir, already gross margin calculated in above bit 32,67,000, 45,37,500. So start with gross margin, sir. Operating expenses already calculated using the activity based costing system. Operating expenses already calculated by using activity based system. So 6,55,600, 10,395. So finally operating income. Next, operating income divided by revenue into 100. Operating income divided by revenue into 100. That is the operating income in terms of percentage 2.33% to 3.71%. Okay, so this is the ABC costing, sir. Next, cost sheet. A Limited produces a single product, namely X. During the month of December 2021, the company has produced 14,560 tons of X. The details for the month of December 2021 are as follows. Sir, production volume 14,560 tons, sir. Production volume during the month of December. Next, product name X. Material consumed for this production activity 15 lakhs rupees. Cost of material consumed. Power consumed. Diesel consumed. that is the direct expenses. Wages and salaries paid, so that is the direct wage cost. Gratuity and leave encashment paid, that is also direct wage cost. Hiring charges paid for HEMM, so that is the hiring the machinery. So hiring charges for using tools, 13 lakhs. Hiring charges paid for cars used for office official purpose, 80,000. This is the admin expenses. Above item is general direct expenses, sir. Next, reimbursement of diesel cost for the cars. So that is also general expenses. Next, the hiring of cars attracts GST under reverse charge mechanism at the rate of 5% without credit. So reverse charge mechanism means here recipient paid, sir, GST. So maintenance cost paid for weighing bridge, so use it for weighing of final goods at the time of dispatch. Next, AMC annual maintenance cost, annual maintenance charges cost of CCTV installed at weighing bridge. Okay, use it for weighing of final goods at the time of dispatch, in brackets. And factory premises is 6,000. Sir, annual maintenance charges cost of CCTV installed at weighing bridge. So under factory premises, sir, amounts to 6,000 and 18,000 per month respectively. TA and DA and hotel bills paid for salesman is 16,000. So the company has 180 employees, works for 26 days in a month. So number of working days in a month, 26 days, sir. So here number of employees, 180 employees. Prepare cost sheet for the month of December 2021. See this suggested answer, sir. Cost sheet. Materials consumed, it is a part of prime cost. Wages and salaries, that is direct wage cost. Gratuity and leave encashment, that is also part of direct wage cost. So finally employee cost equal to 108 lakhs 20,000. So here power cost 91,000 direct expenses, diesel cost direct expenses. So hiring charges, heavy machinery, sir, hiring charges for using equipments, nothing but direct expenses. So 13 lakhs. Next, AMC cost of CCTV installed at factory premises, sir. Factory premises 18,000, that is also direct expenses. Okay, that is also direct expenses. Here AMC charges factory premises 6,000, weighing factory premises 18,000, sir. Weighing bridge area 6,000, sir. Okay, right, correct, sir. So factory premises 18,000. So finally cost of production of cost of goods sold 138 lakhs 22,000. Okay, so prime cost to add factory overheads. Here factory overheads only one element is there. Annual maintenance charges of CCTV installed at factory premises, only one item. So factory overhead charge. Then we get factory cost. Sir, here inventories relating to work in progress nil. Admin charges relating to production nil, sir. So cost of production is factory cost becomes cost of production. Here inventory levels nil, sir. So therefore cost of production becomes cost of goods sold. If there were no inventory levels relating to finished goods, in that case cost of production becomes cost of goods sold. So this is the cost of production. Okay. Next, hiring charges of cars, reimbursement of diesel cost. Next, here reverse charge mechanism, recipient paid GST, that is also charged to customer. Maintenance cost for weighing bridges 7,000. AMC cost, annual maintenance charges of weighing bridges 6,000. T and DS 6,000. Sir, these are the expenses related to general and selling. General and selling expenses both are merging, sir. So finally cost of sales equal to 139 lakhs 56,000. Next, so cost sheet completed, sir. Next, compute the earnings per man shift and output per man shift for the month of December 2021. So here working days given in a month 26 days, sir. See this man shift 180 employees 26 days, so 4,680 man shifts. So computation of earnings per man shift. So earnings per man shift is equal total employee benefits paid divided by man shift. Here employee cost equal to wages and salary 64 lakhs. So gratuity and leave encashment 44 lakhs 20,000. So finally employee cost 108 lakhs 20,000, sir. 108 lakhs 20,000 divided by 4,680, that equal to earnings per man shift equal to 2,312. Next output per man shift, sir. Output per man shift. So here total output, sir. See the question. Output during the month of December 14,560. 14,560 divided by 4,680 man shifts. So finally output per man shift equal to 3.11 ton approximately. So this is the cost sheet. Next one, cost accounting system, sir. X Limited maintains non-integrated accounting system, sir. So that means two sets are maintained. The following are the data related with the year. So 21, 22, sir. Opening balances, here amounts are given in thousands. Stores ledger control account shows a debit balance of 48,000 in thousands. Work in progress control accounts 12,000. Here rupees in thousands, sir. 12,000 thousands. Next finished goods control account shows a debit balance of 2,58,000. Building construction account 6,000. Cost ledger control account shows a credit balance of 3,24,000. So next, during the year following transactions took place. Materials purchased 24,000. Materials issued to production department 30,000. Material issued to general maintenance 3,600. Material issued to building construction 2,400. So here materials purchase entry, sir. Material purchase entry. Stores ledger control account debtor to cost ledger control account. Next, material issued to production. Work in progress control account debtor to stores ledger control account. Material issued to general maintenance, that is the factory overhead control account debtor to stores ledger control account. Material issued to building construction account debtor to stores ledger control account. Next, wages, total gross wage paid, sir. So wage control account debtor to cost ledger control account 90,000, sir. Out of that 24,000 indirect wages, sir. 6,000 building construction, sir. Balance amount to 90,000 minus 30,000 is equal to 60,000, sir. See the here wage control account, to cost ledger control account 90,000. So factory overhead control account 24,000, building construction account 6,000, balance in figure work in progress control account, that is the wages charged to production. So transaction is wages charged to production is 60,000. Okay, right. See this stores ledger control account, sir. So two balance brought down opening balance. Next to raw material purchase, raw material issued to production, raw material issued to factory maintenance, raw material issued to building construction. Okay, one more transaction. At the end of the year, the stock of raw material and stock of work in progress closing balances are given. The loss arising in the raw material account is treated as factory overhead, sir. So deficiencies found in stock takings is treated as factory overheads. So in this question, factory overheads balance 3,000, sir. Closing balance directly given in the problem. So finally, stores ledger control account balance in figure 3,000, that should be treated as factory overheads, that is mentioned in the problem. Okay, so deficiency found in stock takings. Deficiency found in stock takings. Here it is normal, sir, so that it is treated as factory overheads. Next, factory overheads, sir. Actual amount incurred excluding items shown above. That means indirect material relating to factory, indirect wages relating to factory. So that means this is indirect expenses 96,000. Absorbed amount in building construction 12,000. Under absorbed amount is 4,800. So royalty paid, that is direct expenses. Selling, distribution and administration expenses 15,000. Sales amount 2,70,000. So at the end of the year, the stock of raw material and work in progress 330 lakhs and 15 lakhs respectively. The loss arising in the raw material account is treated as factory overheads. The building under construction was completed during the year. Okay, so here in this period building construction was completed, sir. So that final balancing amount transferred to cost ledger control account. Here gross profit margin equal 20% on sales. Therefore, COGS equal to 80% on sales. So prepare the relevant control accounts and record the above transactions in the cost ledger of the company. So open the cost ledger account, sir. Okay. So first stores ledger account already explained, sir. Work in progress control account. Work in progress control account. What are the transactions made in this account, sir? Opening inventory of work in progress, closing inventory of work in progress. Both are given in the problem, sir. Next, material issued to production, wages charged to production, factory works charged to production. Next, direct expenses charged to production. So finally, finished goods sent to warehouse. So goods complete transfer to warehouse 1,99,800. Okay, next finished goods control account, sir. Here opening inventory of finished goods 2,58,000. Next, goods received from work in progress 1,99,800, sir. 1,99,800. Total available goods 4,57,800. Out of that, cost of goods sold equal to 2,16,000. Yes, see the working note. COGS equal to 80% of sales. So 2,16,000. 2,16,000. Balancing figure 2,41,800. Next, cost of sales account, sir. So cost of sales account COGS. Next, selling and distribution are charged to sales. So finally 2,31,000 transferred to costing P&L account. Entry costing P&L account debit to cost of sales account. Right. So here costing P&L account debit to cost of sales account. Sales amount 2,70,000. Sales amount 2,70,000. See this, sales 2,70,000. So sales entry, sir, sales entry cost ledger control account debit to costing profit loss account. Cost ledger control account debit to costing profit loss account. Sir, here generally cost ledger control account debit to sales account, sir. Cost ledger control account debit to sales account. Next, sales account debit to costing profit loss account. So sales cancel, final entry cost ledger control account debit to costing profit loss account. This is the entry, sir. Next, factory overheads under charge 4,800. So finally profit, sir, 2,70,000 minus 2,31,000 minus 4,800. So profit to 34,200 transferred to capital account. Here capital account is not maintained, so that transfer to cost ledger control account. Entry costing P&L account debit to cost ledger control account. Next, building construction account, sir. Sir, here building opening balance is 6,000, sir. Material issued to building construction, wages charged to building construction, factory work charged to building construction. So finally total cost incurred 26,400. So here during this period building construction completed, so then transfer to buildings account, but here buildings account not maintained, sir, so that transfer to cost ledger control account. Next, factory order control account, sir. What are the transactions made in this account, sir? First we have to charge. So factory was charged to production, that is question mark, sir. That is missing figure. Sir. This is missing figure, sir. So factory work charged to building construction given in the problem. Next, under absorption, that is given in the problem. Next, indirect material related to factory, indirect wages related to factory, indirect expenses related to factory. So finally, balance sheet figure equal to 1,09,800. Here one important point, sir, here shortage, deficiency found in stock takings, that is considered as factory works, that is 3,000. So finally 1,26,600 minus 12,000 minus 4,800. So remaining balance of 1,09,800. Next, wage control account already explained, sir. Royalty account, that is nothing but direct expenses account. Royalty account is nothing but direct expenses account. So royalty account debit to cost ledger control account. Next, direct expenses charged to production, work in progress control account debit to royalty control account. Next, COGS account, sir. Next, selling and distribution and administration overhead control account. So first, charge cost of sales account debit to selling and distribution and administration overheads. Next, here incurred amount also 15,000, no under absorption, no over absorption. Next, trial balance, sir. Stores ledger control account shows a closing balance of 33,000. Work in progress control account shows a closing balance of 15,000. Finished goods control account shows a debit balance of 2,41,800. So cost ledger control account shows a credit balance of 2,89,800. So tallied, sir. So this is the cost accounting system. Next, batch costing, sir. Batch costing. So here question is asking what would be the optimum run size for stent manufacture. So optimum run size means economic batch size, sir. Economic batch size formula square root of 2AS by C. A stands for annual demand of the company product. S means setup cost per setup. Next, C means carrying cost per unit per annum. So here clearly mentioned. So there will be a demand of 1 crore. Next, here market share 10% of the total market demand. Okay. It is estimated that its cost 3 rupees as inventory holding cost, that is C, nothing but C. Next, setup cost per setup of 450, sir. So here D or A both are same, sir. Annual demand of sales 10% of 1 crore. So 10 lakhs units. Setup cost 450. Carrying cost 36. So economic batch quantity equal to square root of 2 into 10 lakhs into 450 divided by 36. 5,000 units of stents. So this is the economic batch quantity. Minimum inventory holding cost, sir. So here there is a relation between batch size and inventory holding cost. Direct relation. If batch size increases, inventory carrying cost also increases. If batch size decreases, inventory carrying cost also decreases. So that here minimum carrying cost at TBQ, sir. So average inventory, that is the half of the batch size, into carrying cost per unit per annum. So that is the 36. So finally 90,000, sir. 90,000. So this is the minimum inventory holding cost. Okay. Next, job costing, sir. KG Motors Limited is a manufacturer of auto components. Following are the details expenses for the year 2020-21. So opening stock of raw material, closing stock of raw material purchase. Next, direct labor, factory overheads, administrative overheads. Sir, 2021 data is used for calculation of recovery rates, sir. So after calculating the recovery rates, then take the next current year jobs. So that is the during the year 21-22, the company has received an order. So ascertain the cost for given order. So first we have to calculate rates using the past experience. Year 2021 information was given. So that information is used for calculation of recovery rates. So see the solution. Here factory overhead recovery rate, factory overhead in 2021 divided by direct labor cost in 2021 into 100. So 34% of direct labor cost, sir. So here already mentioned the company charges factory overheads as a percentage of direct labor, and administrative overheads as a percentage of factory cost. So here factory overheads are estimated on the basis of percentage of direct labor cost, administrative overheads are estimated on the percentage of factory cost, okay, on previous year's cost. So previous year details readily available, then calculate the recovery rates. So here recovery rates, factory overhead recovered 34% of direct labor cost, administrative overhead recovered at 6.91% factory cost. Right. Next, calculate the overhead recovered based on actual cost for 2020-21 completed. Prepare a job cost sheet for the order received and the price to be quoted if the desired profit is 25% on sales. 25 by 100 on sales, that means 25 by 75 on cost, sir. So here order details are given. Material cost 80 lakhs, labor cost 40 lakhs 50,000. Then we get prime cost. Then charge the overheads by using recovery rates. So here material cost to labor cost, factory overheads estimated, sir, 34% of labor cost. Then we get factory cost. Next, administrative overheads charged, sir. So 6.91% of factory cost. So therefore, next cost of delivery, that is the selling and distribution expenses. Finally, total cost. Next, here profit equal to 25% on sales, that is 25 by 75 on cost. 25 by 75 is nothing but 1/3 on cost. 1/3 on cost means 33.33% on cost. So sales value equal to 204,06,408. Okay, right. So price quotation equal to 204,06,408. Next one. Next, process costing, sir. A company produces a component which passes through two processes during the month of December 2021. Material costing 40,000. Components were put into the process 1, of which 30,000 were completed and transferred to process 2. Those not transferred to process 2 were 100% complete to materials cost and 50% complete as labor and overhead cost. The process 1 cost incurred were as follows. So here two process details were given, sir, during the month of December. Material for 40,000 components were put into the process 1, that is the input quantity introduced into the process 1, of which 30,000 were completed and transferred to process 2. So those are not transferred to process 2, that is work in progress. 100% complete material work, 50% complete labor work, 50% complete in overheads work. So the process 1 cost details are given. Material cost to direct wage cost to factory overheads. So here process 1 details are 40,000 introduced into the process, sir. 50,000 fully completed, sir, in all segments. 10,000 material work 100% completed, labor work 50% completed, overhead work 50% completed, then converted into equivalent units. So finally, in material segment to equivalent units of production 40,000, in labor segment equivalent units of production 35,000, in overhead segment equivalent units of production 35,000, sir. Next, cost incurred during the period 6 lakhs, 7 lakhs, 4 lakhs 90,000, total cost incurred 17 lakhs 90,000. For 6 lakhs amount in material segment, for 6 lakhs amount number of units fully completed, sir, 40,000. In labor segment for 7 lakhs rupees number of equivalent units, sir, 35,000. In overhead segment for this amount number of equivalents 35,000. So A by B, then we get cost per equivalent unit, sir. After calculating the cost per equivalent unit, then directly prepare the process 1 account. So here materials 40,000, sir. Materials 40,000. So cost 6 lakhs, labor 7 lakhs, overhead 7 lakhs 90,000 by process 2. That means output units completed and transferred to next process 30,000 units, sir. 30,000 units into 49. Next, closing work in progress, sir. Closing work in progress 10,000 units material work fully completed, labor work 50% completed, overhead work 50% completed. So fully completed 10,000 into 15, 5,000 into 20, 5,000 into 14. So finally 3,20,000. Therefore, process 1 account to completed, sir. Next, process 2 details. Of those transferred to process 2, 28,000 units were completed and transferred to finished goods store. There was a normal loss with no salvage value of 200 units in process 2. Okay. There were 1,800 units remained unfinished. That is the closing work in progress. So, input introduced in process 2, 30,000, sir. At the time of processing, normal loss 200, sir. So, 200. Next, the closing work in progress, so 1,800, sir. So, finally 28,000, right. So, closing work in progress for completion in material segment 100%, sir. Labor segment to 25%, sir. Overhead segment to 25%. Cost incurred in process 2 are as follows. Packing material 1,60,000, direct wage cost incurred 1,42,250, factory works 1,70,700. So, packing material cost is incurred at the end of the second process as protective packing. So, protective packing means primary packing, sir. So, primary packing cost charged only completed units, sir. Only charged to completed units. Here completed units 28,000, sir. So, this amount 1,60,000 amount charged to only completed units, sir. Right. So, in second process completed units 28,000, sir. See the suggested answer, sir. So, first process 2, sir, 30,000 units introduced. Out of that 28,000 fully completed in all segments, material work 100% completed, labor work 100% completed, overhead work 100% completed. So, therefore, 28,000, 28,000, 28,000. Normal loss 200, sir. So, normal loss should not be considered. Automatically, this quantity loss pass on to customer, sir. Next, closing work in progress, sir. Closing work in progress 1,800 units. Material segment 100% work completion, labor segment 25%, overhead segment 25%. So, 100% of 1,800, 1,800, 25% of 1,800, 450, 25% of 1,800, 450. Okay. So, finally, in material segment 29,800 equivalent production, labor segment 28,450 equivalent production, overhead segment 28,450 production. Next, cost per unit calculation, sir. So, here input received from process 1. So, cost of input from process 1 equal to 14,70,000. Next, cost incurred during the process, material segment, material, additional raw material cost nil, sir. Labor 1,42,250, overhead 1,70,700. So, finally 3,12,950. Equivalent units, sir. For this amount, number of equivalent units, sir, 29,800. In labor segment, for this amount, number of equivalent units 28,450. In overhead segment, for this amount, number of equivalent units 28,450. So, finally, cost per equivalent unit equal to 49.3289. So, labor 5 rupees, overhead 6 rupees, finally 60.3289. So, fully completed unit cost 60.3289. Then process 3 accounts, process 2 accounts, sir. So, input received from process 1, 30,000 units, amount 14,70,000. Next, packing material 1,60,000, direct wage cost of 1,42,250, factory works 1,70,700. Next, normal loss 200 units. Realizable value 0, sir. Finished goods here 28,000 into 60.3289. So, finally 18,49,209. Next, closing work in progress, sir. So, closing work in progress units 1,800 units. Equivalent units 1,800 to 450, 450. 1,800 into 49.3289. Next, 450 into 5 rupees. Next, 450 into 6 rupees. So, finally, answer 93,741. So, this is the process 2 account. Okay. Right. Next, service costing, sir. Navya LMV Private Limited operates cab or car rental service. Cab or car, both are same. So, cab, some places that is cab service and some places that is car service, car rental services. In Delhi, it provides its services to the offices of Noida, Gurgaon and Faridabad. At present, it operates CNG fueled cars, but it is also considering to upgrade these into electric vehicles. So, the details related with the owing of CNG and electric vehicle propelled cars are as tabulated as below. Particular sir, CNG car, EV car. EV car means electric vehicle car. So car purchase price 9,20,000, electric vehicle purchase price 15,20,000, government subsidy CNG car nil sir, EV car 1,50,000. So life of the car CNG 15 years, electric vehicle car life 10 years. Residual value 95,000 to 1,70,000. Mileage here 20 kilometers per kg of CNG, here 240 kilometers per charge. Electricity consumption for full charge equal to 30 kilowatt hours. So that means 240 kilometers run per 30 kilowatt hours. CNG cost per kg 60 rupees, power cost per kilowatt hour 7.60, annual maintenance 8,000, 5,200, annual insurance cost 7,600, 14,600, tire replacement cost in every 5 years so 16,000 to 16,000, battery replacement cost in every 8 years, 12,000 to 5,40,000. So apart from the above, the following are the additional information. So particulars, average distance covered by a car in a month 1,500 kilometers, delivery driver's salary 20,000 per month, garage rent per car 4,500, share of office and administrative cost per car 1,500 per month. Required calculate the operating cost of vehicle per month per car for both CNG and electric vehicle options. So here question is asking calculate the operating cost in case of both models. So here model 1 CNG vehicle, model 2 electric vehicle sir. So in both cases calculate the operating cost. So operating cost divided into 3 parts, running cost, next to fixed cost, next to semi variable cost. So variable expenses, semi variable expenses, fixed expenses. So this is the problem sir. Sir, here calculation of depreciation per month. So first we have to calculate depreciation per month. Here depreciation period basis sir. So purchase value 9,20,000 CNG model, electric vehicle model 15,20,000. So government subsidy in case of CNG car nil sir, in case of electric vehicle 1,50,000. So residual value means that is the scrap value at the end of its life. In case of CNG car 95,000, in case of electric vehicle 1,70,000. So finally depreciable value of car equal to 8,25,000, 12 lakhs in case of electric vehicle. So life of the car 15 years to 10 years. So annual depreciation in case of CNG car 55,000 sir. So that is the depreciable value of the car. So depreciable value of the car sir, depreciable value, how to calculate depreciable value of car? Purchase price minus government subsidy minus scrap value at the end of its life, that is the numerator, denominator life. So we get annual depreciation in case of CNG car 55,000, in case of electric vehicle 1,20,000. So depreciation per month. So here 1 month details are given, so that depreciation converted into per month sir. So 4,583.33, 1,20,000 divided by 12, 10,000 sir. So this is the depreciation calculation. Next to electricity consumption in case of electric vehicle, fuel consumption in case of CNG vehicle. So in case of CNG vehicle, fuel consumption sir, average distance covered in a month 1,500 kilometers sir. Mileage, CNG car gives 20 kilometers mileage for 1 kg CNG. Quantity of CNG, sorry, 75 kg sir, quantity of CNG 75 kg. Next, cost of CNG per kg 60 sir. So CNG cost per month equal to C into E 75 kg into E 60 rupees 4,500. See this sir, here mileage 20 kilometers per kg sir. Here mileage 20 kilometers per kg. For 20 kilometers, 1 kg CNG consumed, 1 kg gas consumed sir. For 1,500 kilometers, question mark. So 1,500 divided by 20, 75 sir. So totally for 1,500 kilometers, 75 kgs gas consumed sir. 75 kgs gas consumed. So cost of fuel or cost of CNG per kg 60 rupees, 75 kg into 64,500. In case of electric vehicle model, mileage 240 kilometers per charge, sir. So electricity consumption for full charge 30 kilometers. So 30 kilowatt hours for 30 kilowatt hours 240 kilometers. 240 kilometers for 1500 question mark. So 240 divided by 30 into 1 minute, sir. For 240 kilowatt hours, sorry, for 30 kilowatt hours, sir, for 30 kilowatt hours, run kilometers, 240 run kilometers. Okay, so for 1500 run kilometers, question mark. So here (240) mileage, sir. Here electricity consumption 187.5, sir. 187.5. So per cost, power cost per kilowatt hour 7.60. 187.5 into 7.60, 1425. So cost of fuel consumption or cost of electricity consumption completed, sir. So this is a working note 2. Next, working note 3. Amortized cost of tire replacement. Life of the vehicle 15 years. Electric vehicle life 10 years. Replacement interval. In case of CNG 5 years. In case of electric model 5 years. Number of time replacements required, sir. 2 times, sir, during the life. Here 1 time, sir. So after 5 years, tire replacement, sir. Next, after 10 years, tire replacement, sir. So finally 2 times, sir. Number of time replacements required 2 times. In this case, only 1 time, sir. So after 5 years, tire replacement, sir. So life total 10 years, sir. So total 10 years, 1 time replacement, sir. Cost of tire for each replacement in case of CNG model 16,000, in case of electric vehicle model 16,000. So total replacement cost to 32,000, 16,000. Amortized cost per year 2,133.33, 1,600. So therefore, cost per month equal to 177.78. Next, 133.33. Next. Battery replacement, sir. Life of the vehicle 15 years in case of CNG, in case of electric model 10 years. Replacement interval 8 years, 8 years. So during the life only 1 time replacement in case of CNG. In case of electric vehicle only 1 time, sir. Cost of battery for each replacement in case of CNG 12,000, in case of electric vehicle 5,40,000. So total replacement cost in case of CNG 12,000, in case of electric vehicle 5,40,000. Amortized cost per year 12,000 divided by 15 years. 12,000 divided by 15 is equal to 800. So 5,40,000 divided by 10, 54,000. So cost per month equal to 66.67. Electric vehicle model 4,500 month. 800 divided by 12, 54,000 divided by 12. So these are the working notes, sir. So first one depreciation, second one fuel consumption in case of CNG, electricity consumption in case of electric vehicle. Next, depreciation on tire or amortized cost of tire replacement. Next, amortized cost of battery replacement. So now start the operating cost statement. So running cost, sir. Running cost to fuel cost or power consumption. Next, maintenance cost, annual maintenance cost, annual insurance cost, amortized cost of battery replacement, fixed charges. fixed charges. So collectively operating cost per month, right, operating cost per month, sir. So just to calculate the operating cost of vehicle per month in case CNG, in case of electric vehicle. So in this problem, main important things, cost of fuel consumption, cost of electricity consumption in case of electric vehicle, next depreciation in both cases, depreciation calculation in both cases, next amortized value of battery, next amortized value of tires. So these four things are very, very important, sir. After that, so prepare the operating cost statement in regular model. Okay, so this is the operating cost calculation. Next, standard costing. The standard output of a product D, 50 units per hour in a manufacturing department of company employing 100 workers. So that means 100 workers, 1 hour working. So that means 100 hours. The standard output of product D is 50 units per hour in manufacturing department of a company employing 100 workers. That means 50 units allowed time equal to 100 hours, sir. 50 units allowed time equal to 100 hours. So when 100 workers work for 1 hour, the standard output is 50 units. So that means 50 units required time equal to 100 hours. When 100 workers work for 1 hour, 100 workers work for 1 hour, sir. 100 workers work for 1 hour, the standard output is 50 units. So standard man hour per unit equal to 100 hours divided by 50 units, so that is 2 hours per unit. That is the standard time allowed for 1 unit. Next, here actual output equal to, please search the department producer 1920, sir. 1920 into 2 hours, 3480 hours. Next, in a 40 hours week, the department produces 1920 units of product D. Despite 5% of the time paid was lost due to abnormal reason, the hourly wage rates actually paid were 12.4 rupees, 12 rupees, 11.4 rupees respectively to Group A, consisting of 10 workers, Group B consisting of 30 workers, Group C consisting of 60 workers. So finally 60 plus 30 plus 10, 100 workers. Okay, the standard wage rate per labor is same for all the workers. So that means SR, standard wage rate is same for all the workers. Labor efficiency variance is given 480 favorable. Labor efficiency variance means the deviation between actual hours worked in standard proportion and actual hours worked in actual proportion at the standard rate. Actual hours worked in standard proportion, actual hours worked in actual proportion at the standard rate. So using this one, then find out the standard wage rate per hour. Here question is mentioned, standard wage rate per hour is same in all segments. So next, calculation of actual costs are Group A, Group B, Group C. Number of workers 10, 30, 60. Actual hours paid 10 into 40. Here available working hours in a week 40, sir. 10 into 40 400. 30 into 40 1200. 60 into 40 2400. Rate 12.4, 12, 11.4. Next, amount AQ actual labor cost incurred. For actual output 46,720. Idle hours 5%, sir. So finally actual hours worked in case of Group A 380, in case of Group B 1140, in case of Group C 2280, finally 3800. Next, calculation of standard wage rate. So here labor efficiency variance 480 favorable, sir. Standard hours in actual proportion minus actual hours into standard rate. So here 3840 minus 3800 into SR. So finally SR equal to 12 rupees. Right, sir. This is not labor mix, sir. This is labor efficiency. Sorry, this is labor efficiency, sir. So labor efficiency. Labor efficiency variance means it is the deviation between standard hours allowed for actual output and actual hours worked for actual output. South Africa. Standard hours allowed for actual output and actual hours worked for actual output with the standard rate. Labor mix variance, sir, it is the deviation between actual hours worked in standard proportion and actual hours worked in actual proportion of yes, sir. So this is not mix variance, sir. This is efficiency variance. Sorry, this is efficiency variance. Previously, this is mixer. I think this is not mixer. This is efficiency. So labor efficiency variance equal to standard hours allowed for actual output and actual hours worked for actual output. So standard hours allowed for actual output. Standard hours allowed for actual output to 3,840. So this is the standard hours allowed for actual output, 1,920 into 2. Okay, so 3,840. So 3,840 minus 3,800. So finally standard wage rate 12 rupees. Next, labor cost variance. Once rate calculated, then calculate the labor cost variance. Standard hours into standard rate, that is the standard labor cost for actual output. Actual labor cost for actual output, above calculation, see the above calculation. So finally 640. Next, labor rate variance. Labor rate variance, it is the deviation between standard wage rate per hour and actual wage rate per hour at actual working hours. Right. Next, this is the labor gang variance. Labor gang variance is nothing but labor mix variance. So here labor mix variance 0, sir. Actual working hours in standard proportion, actual working hours in actual proportion, both are same, sir. So as the number of workers in standard and actual is the same. So that means actual working hours in standard proportion, actual working hours in actual proportion, both are same. Therefore, mix variance nil, sir. Next, labor yield variance. Labor yield variance equal to average standard rate per hour of standard gang into total standard time in hours, total actual time hours. So that means it is the deviation between standard hours allowed for standard hours specified for actual output, standard hours specified for actual output and actual hours worked for actual hours worked in standard proportion, actual hours worked in standard proportion. So take the difference into standard rate. So 480 favorable. Next, total labor idle time variance. Total idle hours into standard rate per hour. So finally 2,400. So this is the standard costing, sir. Next, marginal costing. A Limited manufactures 3 different products and following information has been collected from the books of accounts. Sales mix variance, selling price variance, variable cost, total fixed cost. The company has currently under discussion a proposal to discontinue the manufacture of product U and replace it with product M and replace it with product M when the following results are anticipated. Product S, product T, product M. So present to STU, sir. So proposal is STM. So sales mix, selling price, variable cost. Fixed cost in both cases same, sir. Sales value previous past case 120 lakhs, in proposal 128 lakhs. Compute the PV ratio, total contribution, profit and break even point for the existing product mix. So existing product mix, sir, see the existing product mix S2UV. So selling price that is given in the problem. Selling price is given in the problem. Selling price is given in the problem. 600, 800, 400. Next, variable cost, then contribution per unit. PV ratio equal to C by S into 100, sir. So PV ratio for product S equal to 50%, PV ratio for product T equal to 50%, PV ratio for product U equal to 40%. Here sales mix ratio given, sir. So weightage, sales mix ratio weightage 25, 35, 40. So therefore weighted PV ratio. So 12.5, 17.5, 16. So finally weighted PV ratio of the company 46%, sir. So therefore present total contribution 120 lakhs into 46%. So finally we get company contribution equal to 55 lakhs 20,000. Company incurred fixed cost 36 lakhs. So company present profit 19 lakhs 20,000. So present break even equal to fixed cost divided by PV ratio. So fixed cost 36 lakhs, sir, divided by PV ratio 0.46. So finally 78 lakhs 26,087. Next, Proposal, sir. Proposal S2M, STM, STM. Same procedure, sir. Selling price, variable cost, contribution per unit, PV ratio, sales mix. So, contribution per rupee of sales. Contribution per rupee of sales. So, in case of yes, contribution per rupee of sales equal to 20%, T 17.5, M 12.5. So, total 50%. So, that is the weighted contribution. So, proposed total contribution equal to 128 lakhs into 50%, 64 lakhs. Next, the company incurred fixed cost amount 36 lakhs, sir. So, fixed cost to be incurred 36 lakhs. So, profit to be made 28 lakhs. So, previously 19 lakhs 20,000. So, at proposal 28 lakhs, sir. So, final conclusion, proposal is the best, sir. Proposal should be accepted. Next, budget and budgetary control. Maharatna Limited, a public sector undertaking, PSU, produces product A. The company is in process of preparing its revenue budget for the year 2022. The company has the following information which can be useful. Next, it has anticipated 12% growth in sales volume from the year 2021 of 4,20,000 tons. The sales price of 23,000 per ton will be increased by 10% provided wholesale price index increased by 5%, sir. To produce 1 ton of product A, 2.3 tons of raw material are required. The raw material cost is 4,500 per ton. The price of raw material will also increase by 10% if wholesale price index increase by 5%. The projected increase in wholesale price index for 2022 4%, sir. A total of 6,000 employees works for the company. The company works 26 days in a month. 85% of employees of the company are permanent and getting salary as per 5-year wage agreement. The earnings per man shift means an employee cost for a shift of 8 hours. So, one shift equal to 8 hours is 3,000 rupees excluding terminal benefits. The new wage agreement will be implemented from 1st July 2022 and it is expected that 15% increase in pay will be given. The casual employees are getting a daily wage of 850 rupees. The wage linked to consumer price index. The present consumer price index is 165.17 points and it is expected to be 173.59 points in the year 2022. Next, power cost for the year 2021 is 42 lakhs for 7 lakhs units. 1 unit equal to 1 kilowatt hour. Okay, 60% of power is used for production purpose directly related to the production volume and remaining are for employee quarters and administrative offices. During the year 2021, the company has paid 60 lakhs for safety and maintenance works. Okay, the amount will increase in proportion to the volume of production. During the year 2021, the company has paid 1,20,000 for the purchase of diesel to be used in car hired for administrative purpose. The cost of diesel will increase by 15% in year 2022. During the year 2021, the company has paid 6 lakhs rupees for car hire charges excluding fuel cost. Okay, in year 2022, the company has decided to reimburse the diesel cost to the car rental company. Doing this will attract 5% GST on reverse charge mechanism. Okay, so that means recipient paid, sir. Recipient paid. So in this situation, so reverse charge mechanism, sir. So GST on reverse charge mechanism basis on which the company will not get the GST input credit. So ITC not available, sir. So in reverse charge mechanism, recipient paid, sir. So that should be added to the cost. So depreciation on fixed assets for the year 2021 80 crores 40 lakhs and it will be 15% lower in 2022. Required from the above information, prepare the revenue flexible budget for the year 2022 and also show the budget profit or loss for the year. So see the suggestion answer, sir. So this is the revenue budget flexible model. Maharatna company for the year 2022. So while preparing the flexible budget, please follow the marginal costing pro forma. So sales revenue, next raw material cost, wage cost, total wage, power cost, safety and maintenance cost, diesel cost, hire charges. So the total cost, sir. So here sales revenue, sir, directly total cost will be deducted, sir, then we get the profit, sir. So here questionnaire not following marginal costing format, sir, just to sales minus total cost we get the profit, sir. So in 2021 sales volume 4,20,000 tons, sales volume 4,20,000 tons, okay, 4,20,000 tons. So in 2022 12% growth, sir. So 112% of 4,20,000, so 4,70,400, that is the sales volume. Selling price per unit term, selling price per unit 23,000 per ton will be increased by 10%, provided wholesale price index increased by 5%. So that is the condition. So here in 2021 23,000, so the projected increase in wholesale price index for 2020 to 4%, sir. Here if wholesale price index increases by 5%, in that case selling price increases by 10%, otherwise selling price is same, sir. So 23,000. Next sales value, next raw material cost, sir. Raw material cost here 2.3 tons, 1 ton output required 2.3 tons. So finally 9,66,000. Here 10,81,920. Price per ton directly given in the problem 4,500. So this is the 4,500, sir. The price of raw material will also increase by 10% if wholesale price index increases by 5%, but in 2022 wholesale price index only just 4%. So the projected increase in wholesale price index for 2022 4%. So no change, sir. In 2022 is same. So total raw material cost. Next wages and salary cost. Wages to casual employees. So 15% of 6,000, that is 900 employees. 900 employees 26 days. 900 employees 26 days. So 85% of employees of the company are permanent and getting salary. Okay. So 15% casual employees, sir. Am I right? So here wages to casual employees 15% of 6,900 employees. Okay. So 900 employees into 26 days in a month. 26 days in a month. Okay, 26 days in a month. Okay, 26 days in a month, sir. Next rate 850, 12 months. So finally 2386.80. Here 2508.47. Okay, next salary to permanent employees 85% of 6,000. So same model, sir. So finally wages and salaries. Next power cost of fuel production for employees and office. For production purpose power consumption, for employees office purpose power consumption, for total power consumption. So power rate per unit to 6 rupees. So total power cost to 45.04. So safety and maintenance cost. Next diesel cost. So car hire charges, sir. Car hire charges, fuel reimbursement. So 1.38 in 2022 proposal, sir. So here recipient paid, sir. GST ITC not available, sir. So that should be added, sir. So total car hire charges. Next depreciation in lakhs, sir. So here depreciation directly given 80 crores 40 lakhs. So rupees in lakhs equal to 8,040 lakhs. Here 6,834. So finally total cost. So sales minus total cost equal to profit. Okay. Next, explain the difference between controllable cost and uncontrollable cost. So cost that can be controlled typically by a cost, profit or investments center manager is called as controllable cost, just like controllable variance. Controllable costs incurred in a particular responsibility center can be influenced by the action of the executive heading that responsibility center. Simply, person affected, sir, due to person stability, cost will be reduced, sir. In controllable variance, already మనం discussed in standard costing. In case of controllable variances, action should be applied. Same, just like in case of uncontrollable variances, standards may be revised. Same procedure. Costs which cannot be influenced by the action of the specified member of an undertaking are known as uncontrollable cost. So that means outside factors are impacted, sir. Outside factors are implemented. So outside factors are implemented, that cost is uncontrollable cost. So costs are affected due to outside factors, that is uncontrollable cost. That is uncontrollable cost. So costs are affected due to person. So that is the controllable cost. Next, cost plus contract, sir. So under cost plus contract, the contract price is ascertained by adding a percentage of profit to the total cost of the work. So first we have to ascertain the cost of the project or cost of the contract. Then a fixed percentage of profit should be added. Then decide the contract price. So this type of contract is calling as cost plus contract. So under cost plus contract, the contract price is ascertained by adding a percentage of profit to the total cost of the work. For example, a period of contract to 15 months. So after completion of 12 months, ascertain the cost. Then add agreed desired profit. Fix the price. So that is the cost plus contract. Such type of contracts are entered into when it is not possible to estimate the contract cost with reasonable accuracy due to unstable condition of material, labor, services. So sometimes material prices are increased due to external factors, sometimes labor rates are increased due to external factors. So in this case, cost plus contracts are very, very favorable. So in these situations, cost plus contracts are very favorable, sir. In case of contractor, so cost incurred for this contract plus fixed percentage of profit, then decide the price. Following are the advantages. The contractor is assured of a fixed percentage of profit. There is no risk incurring any loss on the contract. It is useful especially when the work to be done is not definitely fixed at the time of making the estimate. Contractee can ensure himself about the cost of contract. He is empowered. So that is, he is empowered to examine the books and documents of the contractor in cost plus contracts. Rights available to the contractee. So contractee can ensure himself about the cost of contract and he is empowered to examine the books and documents of the contractor to ascertain the veracity of the cost of contract. So these are the benefits of the cost plus contracts. Next, is reconciliation of cost accounts and financial accounts necessary in case of integrated accounting system? No. So in integrated accounting system, only one set of books are maintained. In integrated system, only one set of books are maintained. So no need of reconciliation, sir. So in integrated accounting system, cost and financial accounts are kept in the same set of books. Such a system will have to afford full information required for costing as well as financial accounts. In other words, information and data should be recorded in such a way so as to enable the firm to ascertain the cost of each product, job or process or operation. So it also ensures the ascertainment of marginal cost variances, abnormal losses and gains. In fact, all information that management requires from a system of costing, for doing its work properly is made available. So integrated accounts give full information in such a manner so that the profit and loss account and the balance sheet can be prepared according to the requirement of law, and the management maintain full control over the liabilities and assets of the business. Since only one set of books are kept for both cost accounting and financial accounting purpose, so that there is no necessity for reconciliation of financial cost and financial accounts. So this is common rule. Next, discuss the impact on information technology in cost accounting. So this is the first chapter, sir. So impact on IT in cost accounting may include the following. So in present scenario, it is very important role plays. IT role plays, sir. So the impact of IT in cost accounting may include the following. After the introducing the ERPs, different functional activities get integrated, and as a consequence of single entry into the accounting system provides the custom-made reports for every purpose and saves an organization from preparing different sets of documents. Reconciliation process of results of both cost and financial accounting system become simpler and less sophisticated. So the main purpose, the main advantage, less time consuming, more economical. So this is the best. So this is the impact of IT in cost accounting may include the following. So next, the second, a move towards paperless environment can be seen, where documents like bill of material requisition note, goods received note, labor utilization reports, etc. are no longer required to be prepared in multiple copies. So information technology with the help of internet, helps in resources procurement and mobilization. Next, cost information for a cost center or cost object is ascertained with an accuracy in timely manner. Next, uniformity in preparation of reports, budgets and standards can be achieved with the help of the IT. Next, cost and revenue variance reports are generated in real-time basis, which enables the management to take the control measures immediately. So IT enables an entity to monitor and analyze each process of manufacturing or service activity closely to eliminate non-value added activities. So these are the main benefits, sir, for IT, right? Okay, thank you, right.